Welcome to The Explainer. We're looking ahead to 2026, and folks, it's shaping up to be a huge turning point for the economy and for your portfolio. We're going to break down exactly what the Fed's next moves could mean for your money, and way more importantly, how you can get ready for it right now.
So, after a long and, let's be honest, painful period of high interest rates, a change is finally on the horizon. A rate cut is coming. But here's the billion-dollar question that's going to define everything. Is the Fed cutting rates as a victory lap because they've beaten inflation? Or are they cutting rates in a panic because something in the economy is starting to break? The answer to that changes the entire game for investors.
All right, here's our game plan for today. We'll kick things off by setting the stage for this 2026 rate reversal. Then we'll explore three totally different paths the economy could take. From there, we'll build a powerful all-weather action plan. And to wrap it up, we'll give you your very own investor dashboard so you can see which path is unfolding in real time.
Okay, so to really get a handle on where we're going, we first have to understand the very delicate, kind of tricky economic crossroads we're standing at right now.
You know, we're in a really tough spot. Core inflation has been super stubborn, kind of like gum stuck to the bottom of your shoe. At the same time, the lag effect from all those past rate hikes is finally starting to bite. Think about it like turning a giant cargo ship. You turn the wheel, but the ship itself doesn't actually change direction for a long, long time. We might just now be feeling the real economic impact.
And this brings us right to the heart of the matter. The Fed is almost certainly going to cut rates in 2026, but the reason they cut is what matters. Are they cutting from a position of strength, popping the champagne because inflation is dead? Or are they cutting in a panic because the economy is on the ropes?
So this one critical question creates three completely different scenarios for 2026. You can really think of it like a choose-your-own-adventure for the economy, and our job is to be ready no matter which page we turn to.
This table lays it all out perfectly. You've got Path A, the Goldilocks soft landing, everything's just right. Then there's Path B, the crash scenario, a full-blown hard landing recession. And finally, Path C, what you could call the treadmill path, where we're just running in place. And as you can see, each path has very, very different winners and losers.
First up, let's talk about the dream scenario. This is the one every central banker on the planet is hoping for, where everything just works out.
In this world, the Fed gets to make what are called preventive cuts. Now, this is a super important distinction. They're not cutting rates because the economy's in trouble. They're cutting them because inflation is finally back in its box and they can gently take their foot off the brake. It's a victory lap.
So what happens to your money? Well, if the Fed pulls this off, you can probably expect a big stock market rally, especially for smaller companies. The biggest winners would almost certainly be those sectors that are sensitive to interest rates, like tech and real estate.
Okay, now for path number 2. This is the one everybody's afraid of, where all those high rates finally cause something to snap in the economy. This is the darker timeline. A hard landing means a real recession. We're talking unemployment shooting up, people losing their jobs, and consumers slamming their wallets shut. In this scenario, the Fed isn't making preventative cuts. No, they're making panic cuts, slashing rates not because they want to, but because they have to in order to save a sinking ship. In a world like this, investors run for cover. The stock market would almost certainly take a big hit. Safe haven assets like bonds would suddenly become the star of the show. And you'd see defensive stocks, companies that sell things people need no matter what, like toothpaste and medicine. They would likely hold up the best.
And finally, let's look at the third and maybe the most frustrating path of all, the one where we're just stuck in neutral, running as fast as we can, but going absolutely nowhere.
So in this no-landing scenario, the economy just refuses to slow down. It stays too hot, which keeps inflation stubbornly high, maybe even starting to creep back up. This is the Fed's absolute nightmare. Why? Because it means they can't cut rates at all. Their hands are tied. They have to keep rates higher for longer, and maybe even think about hiking again.
This kind of environment is just plain tough for investors. You'd probably see a choppy, sideways stock market. Growth stocks would get hammered, but here's the twist. Good old-fashioned cash becomes king because you're getting great returns in money market funds. The winners here would likely be quality, value-oriented companies. Think energy and financials that are churning out strong cash flow right now. So, we've got three completely different futures staring us in the face. How on earth do you build a portfolio that can handle all of them? Well, here's the secret. You don't try to predict, you prepare. And here's the blueprint.
Look, the core of a truly smart strategy isn't about gambling on one outcome. It's about being ready for anything. And you can do it with 3 simple steps. First, keep your dry powder, some cash on the sidelines. Second, consider locking in today's amazing bond yields before they disappear. And third, make sure your stock portfolio isn't a one-trick pony. It needs to be diversified.
And here's what that can look like. See that 20% slice for dry powder? That is your secret weapon. That's not dead money. That's a strategic cash reserve that lets you go shopping for amazing assets when they go on sale during a potential hard landing.
And within your stocks, think of it like building a sports team. You're not betting everything on one star player. You have some growth and tech stocks for the good times, the soft landing. You have your defensive players, like staples and healthcare, for the hard landing. And you have some solid value stocks for that frustrating no landing scenario. And maybe a little gold as an insurance policy for all seasons.
Now, to really put you in the driver's seat, I'm going to let you in on the 3 key dials the Fed themselves are watching. You can use these to build your own dashboard and see for yourself which scenario is starting to look more likely.
And honestly, it's simpler than you might think. First, keep an eye on the monthly jobs report. If you start to see a real trend of rising job losses, that is a massive red flag for a hard landing. Second, watch core PCE. That's the Fed's favorite inflation number. If that number is falling steadily below 3%, that makes a soft landing much more likely. And finally, just listen. Listen to what CEOs are saying on their earnings calls. If you keep hearing the phrase weakening demand over and over, that's a pretty clear sign a storm is on the horizon.
Okay, let's bring this all home with the single most important idea from this entire explainer today.
So look, you don't need a crystal ball to be a successful investor. At the end of the day, the question isn't which path will the economy take. The only question that really matters is this: have you built a portfolio that's ready for the journey, no matter what the destination turns out to be?